I was looking at you had your coat button, and I realized I've got the COVID-19, so I'm gonna leave it open.
Well, you know what? I got dressed up for you today. Like, I haven't worn shoes like this in a long time. And then you stroll in your cool boots. I'm thinking, I had some really cool shoes that I took off today. So you dress better than me, too. There's a theme here today.
Yeah.
Horse dresses better.
Well, it's manly footwear.
So welcome. By the way, you all don't know this, but I was texting with Doug late last night, just checking on a couple of things. And then this morning, the first email that I opened after I read my favorite book was from Doug. And it said, "They've canceled my plane." He was leaving Fort Myers today. I was like, yeah, I don't think there are 450 people coming to see me today. So if I have to send the plane, I better send the plane. Fortunately, they figured out, Delta did, how to get you here. So welcome to Atlanta.
Thank you.
We're happy that you made it, yeah. And by the way, you all gave him a great round of applause. You should have waited until he told you what he needs to tell you.
But I'm glad you got it out of the way.
But look, one of the things that we all have to deal with in life is truth, right? And reality. So we'll go through all of it today. And I'll just tell you all in advance, someone asked me a question last week, like, how bad, how low can it go? I said, well, it could go to zero. I'm not talking about interest rates. I'm talking about housing sales. Like, we could not have one for a whole year. I don't think we're going there. But anyway, so Doug, arguably the last 2 to 3 years have been the most volatile years ever in the housing finance business, whether it's in housing sales, housing price increases, interest rate volatility down, up. I mean, we've been all over the place. And this volatility, it's created and continues to create, for the folks that are in the audience today, unprecedented challenges, because they're talking to customers every single day in an attempt to serve them best. Customers want to know what's going on. And again, this industry has just been through an awful lot. So I'm hoping today that we can do an awful lot of education for the folks that are here, so they can take hopefully notes, and they can take information back to their buyers and sellers, and because they know more, do more. So let's start out. Basic fundamental question. What are the fundamental drivers that move the housing marketplace?
Well, it's what you've been talking about the whole time you're up here, is people. Housing starts with people. Everybody on earth puts their head down somewhere at night. So for those who are the least fortunate, might be on the ground. Some folks put their head down in a rental. Some folks put their head down in a house that they own. But it starts with people. And then after you start with people, it moves to those people who have an income. And typically that comes with a job. And then also it comes with a certain place in their life cycle. But it all starts with people.
So we have demographics as a big driver, which seems then to probably make the place we live here a little bit more favorable, right? Because the last time I checked, people aren't finishing their careers in Fort Myers or Fort Lauderdale or Atlanta and moving to Detroit or Buffalo or New York. So people are moving south. So demographics are one of the key drivers, and employment.
That's right. And so the business conditions are always a factor in whether housing is on an upswing or downswing. If business conditions are waning, then typically you see the impact of that on housing, which either doesn't improve from a price perspective or even goes backwards if there's significant job loss. So the business conditions in the South generally have been stronger over the last couple of decades than in much of the rest of the country. And you can see the impact of that. We were talking with the person who sent to pick me up today about the fact that the Atlanta airport, I think, is the busiest airport in the country. There's a reason for that. One reason might be its proximity to the various airways, but more importantly, its proximity to a vibrant economic community.
Yeah. So what about interest rates? So if demographics and employment are two of the key drivers, those seem to be pretty favorable right now. And then, because we do have an all-time low of unemployment right now. What about interest rates? What role do interest rates play in driving the housing marketplace?
Interest rates moderate the level of activity at any point in time. And so what we've seen recently is the largest increase within a one-year time period that we've seen since 1989. And before that, go back to the late 1970s and early 1980s, and you'll see a couple of periods of even more extreme change. The problem with rising interest rates, which are significant in a very short period of time, is that incomes don't change that much. So I think this chart, this is one of my favorite charts. You'll see my favorite chart after a little bit. Last year's favorite chart, by the way, I have on a T-shirt, which I gave to you, I believe. Did you bring that with?
Yeah, when you have a friend who's an economist and he gives you a gift, this is what he gives you.
Yeah. And just for the record, all tests are cumulative.
I had it on one Saturday. I just took a picture of me in it. I said, Doug, I'm studying.
I don't have one of my favorite chart yet, but you'll see that in a little bit. The one that was just up there was the long-term history of interest rates. So if you go back to the very peak on the left-hand side of this chart, that was 1981, and mortgage rates were about 18%. Then at the bottom dip on the far right-hand side, mortgage rates were about 2.5%. It was 40 years between those two time periods. So most all of you in the room today have been in a declining rate environment with some temporary upturns from period to period during your professional careers. So this is going to be a new experience for the vast majority of you. And the change in those rates is driven by the rise in inflation.
And then once upon a time, I had asked you a question, how big of an impact do rates make? And you said, usually not that big of an impact, except, and this was an omen, right? This was like 3 years ago, when they go up really, really fast in a short period of time, which we had not had an environment like that in a long period of time.
Yeah, we've had a couple of tests. We had, for those of you who were in the business in, say, 2012-13, in May of 2013, Chairman Bernanke made a speech in which he said they were going to eventually stop buying mortgage-backed securities. In the next 6 months, when interest rates went up 1%, home sales fell the next spring as a result of that, because incomes don't rise that
fast. Right, yeah. That's the key. So before we discuss the current conditions in housing, I want to talk about kind of going back a little bit, if we could. So we've got the current conditions and everyone's kind of worried and focused on those, but I want to go back because I think it's important that we understand what happened prior, because what happened prior is impacting what's going on right now in our industry and probably will for a while. So it's BC, before Corona. Imagine it's March 2020. So the unemployment rate at the time, March 2020, is 3.5%, all-time low. 30-year fixed-rate mortgages are 3.5%, an all-time low. And you've studied housing your entire life. I've studied it, of course, not as good a student as you, but if someone would have just told me 3.5% unemployment, 3.5% interest rates, I would have told you that in March 2020, housing was probably hot and maybe even red hot. But it wasn't. It was good. It was pretty good. And then a pandemic hit our shores in the latter part of March, and we closed a good portion of the economy here and around the world. Unprecedented. We've never done that before. Here in the U.S., closing the economy down in March eliminated 20 million jobs in 2 months. And unemployment, which does matter because you just told us that unemployment matters, right? It went from 3.5 to 14 plus, almost 15% in 60 days. And 15% is almost like Great Depression numbers. It rivals them, right? So, of course, right after that happened, everybody in the room was planning on there being a great housing market. I mean, we lose 20 million jobs. We're told to stay home. If you go out, don't go near anyone, okay, and wear a mask. And housing gets hot, red hot, as a result of this. Why is that?
Well, there were a couple things happening. If we put up the chart of GDP, I could point you to a couple of the indicators. The first thing that happened was a huge drop in economic activity. With that was what brought on that job loss. So you can see the two big spikes in the middle here. The reason I like this chart is economists usually talk about our national income in quarterly increments. So to the left of the chart, you see pretty stable kinds of quarterly increments, modest, slow growth really. And then you see the impact of the pandemic, the crash, and the very rapid rebound. And then you see 4 or 5 quarters of stronger growth than what you saw prior to the pandemic. So that's so what happened on the supply side of the housing market was with the crash in employment, builders know that people who have jobs are the ones that buy houses. And with millions of job losses, they had to take a pause and say, should we be building more houses if all this many people are going to be out of work? In the meantime, they also had to think about, if we are going to build houses, what do we do to keep our workers safe? But the Congress passed a series of stimuli that transferred huge volumes of cash to households. And of course, the millennials were in the process of ramping up purchases, and many of them were in salaried jobs. The jobs lost were more in the service sector and hourly wages. The homeownership rate among hourly workers is about 40%. Part of it's because many of them are hourly because they're going to school part-time to complete education, or maybe waiting tables or working in service sector jobs that are flexible around school types of things. And so those who had salaries, the PPP program was put in place to actually assist with keeping them employed. They were ready to buy. So when the Fed eased monetary policy and dropped interest rates to rock bottom levels, they also got cash infusion, so the demand side of the equation actually ramped up very quickly. Meanwhile, we were already behind in supply because house prices had been appreciating faster than the long-term average. This sort of supercharged it. And on Pat's t-shirt, you could see the gapping between the pace of price appreciation and the supply. Supply just gradually moving up as builders are trying to find workers. So it was a combination of those things that led to that.
Yeah, well, I was wearing that t-shirt a couple weeks ago. Lisa said, I could see the supply side thing right there. So basically, we lose 20 million jobs, but the people that lost the jobs were mostly in service jobs. We otherwise, monetary policy, the Fed drops rates, so rates go down in a response to what looked like economic collapse. But the fiscal policy out of Washington, not good or bad, not political, just we're going to give money to people so that it doesn't even look like any jobs were lost at that point. Arguably, we gave more money than had they kept the jobs. So you got demand without people building anything at this point.
That's right. One of the little things you talked about, my staff. I do have a great staff. They're very insightful and thoughtful. One of them came forward and said, never before, in terms of fiscal policy, had we tried directly injecting money into people's checking accounts through the IRS. But that's basically what happened with the $1,400 or whatever the number was. They actually injected the money directly into people's accounts. That's never happened before. That has some interesting implications for how fiscal policy might work in the future. just a little twist on where there might be some changes in terms of how the Washington government works.
You know, I didn't know it at the time, but I was sitting, we have a home down at Watersound, which is in Santa Rosa Beach. Many of you all know where that is. And it's a really nice neighborhood. And I'm sitting on the beach, and there's a gentleman behind me. I wasn't listening to his conversation intentionally. It was like a holiday weekend. So he's talking to his son-in-law, and this gentleman lives in the same neighborhood as us. And he goes, this is the fellow who lives there, who's now retired. He goes, yeah, I got my check last week. And I turned around and I said, did you keep it? Did you give it back? But it was a response that was rational and logical for us losing 20 million jobs in an unprecedented environment. All right, so let's move on. Since most people in the room have never been alive to experience inflation, I don't want to assume anything here today, like that people even know what it is. So I'd like you, if you would, to define inflation for us.
The textbook definition of inflation is the increase in the general price level in the economy. So if there's no inflation, prices should stay flat. But of course, individual product and service prices change all the time. Some going up, some going down. Could you have bought a 65-inch flat TV 10 years ago? The answer is no, they didn't make them, right? Now you can buy one and they'll throw in a couple of smaller screens with, that's an example of price declines. That's going on at the same time as, say, the price of automobiles is going up because they're adding more technology to the car. But the inflation is measured as the rate of change in the general price level.
So, and then there's this phrase that the Fed used that I'd like you to explain called transitory inflation.
Yeah, so the first time I heard that word, I said, well, you know, I keep the Oxford English Dictionary next to my computer, where I assume the rest of you do as well. And so I looked up the word transitory, and it says not permanent. Like, well, that's a hole even I can drive my Ford F-150 through. And so under that definition, life is transitory.
And why this matters is because when inflation first showed up for the first time in 40 years in any material way, the Fed's reaction to it was to call it transitory.
Yeah, and by which they meant this will pass quickly.
Right.
And the reason they made that statement was because they could see the ships lining up outside of Long Beach Harbor and the other temporary bottlenecks, temporary from their perspective, on the supply side of the economy. So it wasn't just in housing that supply was an issue, but it was more broadly. Well, there's no question that there were certain bottlenecks that emerged because of the presence of the virus and safety considerations, and not only that, the production of some critical materials which were produced overseas in areas that were hard hit by the COVID. But our view was immediately that there were also geopolitical factors involved, like, for example, the discussion here in the US about whether this emerged from China. And it was in the midst of some changing attitudes about China, and we have a lot of supply chains that were integral, where China was integral to that supply. So our view, after we talked it through, was that, in fact, this is going to lead to a restructuring of supply chains, not just clearing bottlenecks, and that is time-consuming and expensive. And we took the same view on the issue of decarbonization of the economy. If, in fact, there is going to be a long-seated, serious attempt to decarbonize the U.S. economy, that also is going to be time-consuming and expensive, since over 90% of all our energy is carbon-based. So our perspective was those two things mean there's an underlying component of inflation that's actually increasing as opposed to subsiding. So we were never in the transitory camp.
Yeah, no, I remember us having a conversation about that, where you were like, I don't even know what they're talking about at this point. I looked it up and it doesn't mean anything. So what is driving, still at this point, increases that are still over 8%, where we've had inflation under 3 for 40 years in the developed world economy, not just here, but around the world, and now we're at 8%. What's driving?
Well, has anybody in here eaten at a restaurant, say once a month for 3 or 4 months? Have you seen changes in the restaurant? Both the menus, the composition, as the restaurants are trying to maintain profitability, they're also changing the menu to things which have lower costs so they can attempt to hold costs down to the consumers. So it's not just the price, it's also the quantity and the composition of the servings that they're giving you at the restaurant. You'll see also in grocery stores that the box of cereal might now, instead of having, 24 ounces, maybe it only has 20 ounces, but the price is the same. That's actually an increase in price per unit. So hopefully you check the little thing on the side that says cents per ounce. That's a food, that's not part of core, but automobiles, prices of automobiles way up because of constraints on supply, but ongoing, the auto producers now have some pricing power, and they're using that pricing power. So there's a whole bunch, an array of products and services on which the prices have been going up.
So as a layperson, I sit back and I just think, well, we shut all the factories down around the world, said you can't work because of COVID. We shut down many of the services. We gave people money. And so you have people with money to spend. And what we know about Americans is if they have money to spend, they usually will, right? So they're demanding things that they want, and there's fewer of those things. Is it as simple as that got this thing started?
Not completely. You saw the Federal Reserve take their balance sheet from about $4 trillion before all of this started to about $9 trillion. So basically, as the government was running increasing deficits, they were monetizing that. That's the monetary view of inflation. Milton Friedman would be the Nobel Prize winner who was the recognized as the leading advocate of that view, that inflation is always an everywhere monetary phenomenon. If you look at the things that he looked at, he passed away a number of years ago, they are what are called monetary aggregates. And so they're different measures of what constitutes money. They were ramping up tremendously during this time period. Recently, they've seen a big decline as the Fed has stopped monetizing some of the federal debt.
So if all of you want to be really smart, like in front of your friends, raise your hand if you know what QE is. Right, so I thought this would be good. So can you explain to everyone what QE is that built a balance sheet?
Yeah, it stands for quantitative easing. And what that means is the Fed is going to buy assets and hold them on their balance sheet to increase the money stock in the economy. So they buy treasuries, and in this instance, they bought mortgage-backed securities. In fact, they are the single biggest holder of mortgage-backed securities in the world.
So you now know some trivia, because everyone thinks China might be, but the truth of the matter is, the easy way to explain it is the Treasury would issue debt, we collect taxes, we have charges as a government, we have a deficit, and we're issuing debt to pay for that. And then there's mortgages being sold in the market, guaranteed by, you find folks at Fannie Mae, which is owned by the government. And the Fed is coming in and actually buying those.
That's correct.
Right.
Treasury bills and mortgage-backed securities.
Fascinating.
To the tune of $9 trillion. Now, they've said it's a matter of a public record that they would eventually like to not hold any mortgage-backed securities, because they traditionally they've only held treasuries. After the great financial crisis, they went through the first time ever experience of buying mortgage-backed securities. I referenced the speech that Chairman Bernanke made in May of 2013 that said they were going to stop buying at some point. Well, they did stop buying for a while. Then they resumed it with the COVID experience. They have now stopped. They said in June that in June, July, and August, they were going to allow up to $17 billion in mortgage backs to run off each month. That would be the cap. During that 3-month period, about $6 billion ran off. Now the cap is $35 billion, and essentially nothing is running off.
Because rates are, yeah.
Exactly. About 95% of all the mortgages that are guaranteed by Fannie and Freddie have about 150 basis point less coupon. In other words, their interest rate on those outstanding mortgage-backed securities have interest rates 150 basis points or 1.5% lower than current market rates. No one's going to willingly give those up. And so they're saying on the Fed's balance sheet. So it's raising questions. So QT, which is quantitative tightening, is the reverse of QE. So they said we're going to let them run off. That would be tightening, but they're not running off.
You're getting QT'd right now. That's what's going on, right? So the Fed is actually sellers instead of,
Well, they're not sellers.
not sellers, they're just not buyers any longer, right?
Right, and they're letting treasuries are running off. They had about $3 trillion of treasuries that had 24 months or less maturity. So those are running off, and they are not replacing all of them, or they're replacing them with different durations of security.
And all these things that Doug just described in terms of QE now turning into QT and the Fed's activities, that's what's pushing rates up. Those are all complicit to the process right now. So inflation, it's on fire, and the fire department is the Federal Reserve.
Right.
So can you explain who the Federal Reserve is and what exactly their responsibilities are?
Well, they're the central bank. I think you actually have a slide that lists their responsibilities. The number one is monetary policy, and they have a dual mandate within monetary policy that explains what it is. That is keeping inflation to very low levels. They've targeted that at 2%, but that's not a matter of law. That's a choice that they have made. And to maximize employment. So that was actually put in place in 1978 as inflation was rising. And if you looked at employment in that time period, it was declining even as inflation was rising. Part of the reason that the Humphrey Hawkins bill, which was the name of the bill that instituted the dual mandate, happened. Then Paul Volcker was appointed in 1979 and started the process of disinflating the U.S. economy. But one thing that's different today, Chairman Powell, in his press conferences, has several times referenced Paul Volcker, suggesting that he would like to draft on Volcker's reputation and establish himself in that same inflation-fighting mindset. One of the things that Volcker had going for him that is not the same on fiscal policy is that in the early 1980s, we had a series of tax cuts that were put in place to incent growth. So instead of transferring incomes, what was done was fiscal policy was structured to encourage work and people to grow their income, which is a sustained incentive as opposed to, for example, one-time transfers of funds. Then in the middle of the decade of the 80s, there was passed the Graham-Redmond-Hollings bipartisan Deficit Control Act, so that there would also be some restraints on federal spending at the same time as monetary policy was tightening, but the incentives in the tax code would encourage growth. That started the process of that 40-year decline in interest rates. Today, we do not have fiscal policy playing that same role.
So monetary policy, the Federal Reserve, fiscal policy is Washington, the politicians, and their decisions about what they decide to do. And right now, they really need to be coordinating if we're going to get control of this thing, because the Fed can only do so much by themselves.
Yeah, that's right. If it's all, the Fed has two tools. They can do the quantitative easing thing, which the evidence of whether that actually helped is very difficult to find. And the way you can judge that is when in his press conferences, which I assume you all watch the Fed's press conferences, right?
Sure.
That's an economist cocktail. We're all there. We're all there. You know? It's all about liquidity. So, in several of his recent press conferences, he's been asked, what's the impact on interest rates of quantitative tightening? And he's given different answers each time. Well, some estimates are 25 basis points of tightening. Others say it might be less. Others might say it more, which means that the Fed doesn't have a firm view on exactly what the contribution of quantitative easing or the cost of quantitative tightening will be, which leaves them really with their one classic tool, which is the federal funds target and raising interest rates through the federal funds target. If all of the inflation has to be fought just with the Fed funds target, that's a less optimistic view about where things are going. Now, full disclosure, we put a recession into our forecast in our April forecast this past year. We were sort of out there by ourselves. But as we looked forward and thought about this and thought about the misalignment of monetary and fiscal policy, it became really hard for us to see how the Fed could get inflation back to its 2% target just by demand destruction. Because raising interest rates in this environment, you would call that demand destruction. If that's the only tool they have, and if they're in a hurry to get to 2%, then what we put in as a mild recession in the first half, starting in the first half of 2023, will likely be more severe.
Don't worry.
Well, this is payback for 2 really good years.
Yeah, Doug and I were talking earlier. I said, well, explain it to me in layman's terms. Like, we're sitting at a bar. He said, well, it's Friday evening. It's 2020. We have 10 shots of tequila. We're feeling good. You're a realtor. You're a mortgage banker. How's it feel the next day? Mm-hmm. It's the next day. The good news is this: we'll never drink again. We all know it. You all know it. I know it. It's good. We're going to be good. Look, if there's any good news so far, what I've heard is that the Fed said it was transitory. It's a little bit like a weatherman, right? They were wrong. And then when asked about quantitative easing, which is $10 trillion decision they made on our behalf as taxpayers, because that money came from someplace, the answer sounded a little bit like, we just throw shit up against the wall and see if it sticks, right? That's kind of what I heard.
Yeah, it's a theory.
I knew you'd agree with me.
Well, I grew up on a farm, so
All right. So by the way,
but on that front, a speech in New York, I don't know, I had to give a speech last Wednesday, I guess, in New York to receive the award. I put up my energy chart, and if you look at that energy chart, which you can send that if people are interested, on the bottom is this little section that's pretty constant that says biomass. And so I said I shoveled some of that when I was growing up on the farm. There was about 5 people in the audience that got that.
All right, so because every time somebody in the audience now hears about the Fed, I'm sure they don't like that. They don't like them either, right? So Fed funds, what is the Fed funds rate?
It's the interest rate at which banks lend to one another overnight.
Okay.
So banks have to have a certain balance on their financial statements at the end of the close of each business day, and if one needs some additional funds to meet some regulatory requirements, they will borrow for another that has an excess.
So the Fed sets that rate for all.
Yes, yeah. By buying and selling in that space, they manage that within a range. So you'll hear them talking about the Fed funds target range.
And you mentioned demand destruction. I want everyone to hear this, Because when the Fed is raising rates like they are today, what they're really trying to do is reduce consumer demand in every sector so that supply can effectively catch up and prices will slow down. Right?
That's right. You're seeing that in housing in spades.
Yeah, in spades. Yeah, we are seeing it in spades.
Yeah.
I think we're all going to have 10 shots of tequila.
Yeah.
All right, so do 30-year fixed rate mortgages, do they track Fed funds?
Not perfectly. They're related, but over time. You have seen in this instance interest rates and mortgages rise pretty much in parallel to where the Fed funds target has been moving. A lot of that is an expectation signaled by the Fed that says we're going to let mortgage backs run off, but more importantly, we're not buying any. So that's taken out the biggest buyer. And it's a little historical thing. Over that time period you saw that long downturn in interest rates, the primary holder of mortgages has changed 3 times, and something that is unknown is who will be the new primary holder. So it was the thrift industry,
Yep.
which had the qualified thrift rule, which said that a certain percentage of their assets had to be mortgages. Then when the thrift industry died, it went to the portfolios of Fannie and Freddie. Then when our portfolios were constrained, it has moved to the Fed. So as the Fed exits, it's not entirely clear who replaces the Fed and at what interest rates. So that will be something to watch over time.
So is the Fed, based on how aggressive they're being right now, because we haven't seen them be this aggressive in raising interest rates to kind of destruct, if you will, demand, are they right?
Well, there's no question that consumers, for very good reasons, hate inflation. And so something has to be done about it socially. You can see, if you saw the headlines this morning, there were riots in France over the rise of inflation. It's a very socially disruptive phenomenon. And it's because people work hard for their income, and then it's taken away from them by the rise in prices, which devalues each unit of income that they generate. It's especially hard on the poor, because the poor have very limited portfolios and limited resources, most of which is cash in real time. So they actually are hit the hardest. So if you genuinely care about the poor, then crushing inflation is a very important, very important.
It's just painful over the short period of time, right? So we're going through that moment right now where it's very painful. Okay, so we know what drives housing. We've gone through that. We know what happened that created the 2 best years. Oh, you've got a phone call, I think, Thomas.
It's the Fed. They're mad.
Oh, goodness.
Raise them.
So we know what happened that created the 2 best years ever, because you've covered that with us. And then we understand some of the obstacles that now exist in housing. We understand inflation. Doesn't everybody understand inflation now, right? We know transitory doesn't mean anything. Good. So you guys are getting smart here today. We know about QE, QT, Fed funds. We've covered an awful lot. We know a lot more, don't you all agree, than when we got started? Yeah. All right. Well, let's keep this conversation going then, Doug. Let's talk about 2022, like current housing and market conditions. So,
okay.
You want us to tell you, or you want to tell us?
Well, you have the information on the ground, each one of you. So we listen to you. In fact, I would argue, one of the reasons that we've won some forecasting awards is we pay a lot of attention to people who are doing things in real time with their own money. It's one thing to talk about things theoretically. It's another thing to talk to people who actually have skin in the game. So we try to do a lot of that. So what's going on today? So I got in a little bit of trouble with the comms department in June when I said, well, market turn. And they're like, you can't say that. I said, well, It did. Well, you can't say that. Well, what am I supposed to say? And I was having a conversation earlier with a couple of ladies here, and they said, well, you could say, well, the data said it did, and that was a wise statement because that's what happened. The data showed very clear that the rapid rise and the significance of the rise in interest rates had brought a halt to housing activity. You can see it on the far right-hand side of this chart. The sudden and very significant drop that took place. Now, one of the things that we track is relistings. So I didn't put that in the deck there, but we've been launching some of the market data on a market-by-market basis, looking at what were houses listed for on the 1st of January, and then in the most recent month, for that same house, had it been taken down and relisted at a lower price. And it differs from market to market, but clearly all the way across the market, the peak passed in June. How far that will go, we expect the second half of this year will actually show a negative price nationally, maybe 0.5% or thereabouts. The first half is so strong, the full year's number will be about 9%, but that will be misleading in terms of where the market is. Our forecast for next year nationally is about a decline of 1.5%, but we put a risk cone around that, and the bottom of that cone is 5% down. So
what historically, last 50 years, what's the average price increase? Because for a lot of people in the crowd, maybe they've been in the industry 3, 4, 5 years, and as we used the term unprecedented, volatile earlier, what's a normal price increase based on an industry that's as big as this industry?
If you go back to World War II and look at the annual average national nominal interest rate, that's not adjusted for inflation, it's between 4 and 4.5%. If you take out inflation, inflation's around 3.5% over that time period, leaves you with 1%, somewhere between 0.5 and 1% in terms of real price appreciation. You do need some positive real price appreciation to encourage builders to build. That shows that at the margin we need to increase the housing stock. So we went 15% price appreciation in 2020, 20% in 2020, so that's 35% in 2 years, and then another 10% or 15% the first half of this year. It's just not natural, and something has to give.
Yeah, I helped Doug, on the street. I helped him because about a year ago, my son was selling his house, and I sent Doug a video, and his first reaction is that a COVID testing line? No, it's a house that's listed. And it was listed on Thursday, and there were 25 contracts by Saturday evening, and the bid was well past list. And I've financed 375,000 home loans in my career. I'd never seen anything remotely even a little bit like it. So
my favorite statistic in 2021 was that each realtor in the United States had one house to sell.
that was it.
There were equal number of realtors and number of existing homes for sale. It's crazy.
So we had the record increases. And so that was stretching people from an affordability standpoint because 20 and 21 saw prices go up. So you already were seeing it in your surveys when you do your monthly surveys that affordability was beginning to be, kind of stretched. And then we go from 3.5% on interest rates early this year once transitory became that everybody understood the definition was different than everyone thought it was. And so now it's kind of gotten up to 7 something today. So that window, assume we just stayed where we are today over the next 2 years or 3 years, we stayed at roughly right 7% and prices stayed roughly right where they are. Do things get back to normal?
Well, you have to define normal. And you're looking at an economy, so I'm not sure that qualifies. Can we put up the barbed wire chart?
Do you have the bar?
This is my favorite. This, yeah, there's some loops and things. No, keep going. Keep going the other way, other direction. Oh my gosh.
Just give us a second.
There it is.
There we go. We got the bar bar chart.
That's my favorite chart this year, but I haven't got a t-shirt yet. So there's one smooth line in there. So that smooth line establishes the relationship between the vertical axis, which is the median household income, median house price divided by median household income. The theory there is there's a limit, according to the income of a household, of the price that they can pay for a house, right? Sort of common sense. But their ability to pay higher prices is conditioned on whether interest rates are lower or not. So as interest rates fall, the ratio of house price to house income can rise. So that's basically what that's showing. So when you start at the left-hand side of that chart, don't take it down yet. Start at the left-hand side, or I'm sorry, the right-hand side. So interest rates fall to the left. You see that for some 20 years or so, the actual stayed very close to that predicted line. Then you saw the bubble in the 2004 to 2008 time period when that ratio got way out of line. In other words, house prices were way above what was sustainable. Then you saw that it wasn't sustainable and there was the crash. So that ratio fell down below that line. Then for about 3 years, we were back on track. And now we've gotten way above again. So there's only 3 ways in which you can go back to normal. One is incomes rise, one is prices fall, or the third one is a combination of those two. This is why I'm concerned that fiscal policy today is not conditioned on growth and rising incomes, because if it's all left to price, and the Fed exercises the demand destruction that they will have to do to get prices, to get inflation down, it could be very rough.
Yeah, because then incomes don't go up.
They don't go up.
Yeah, and okay, so home prices, last month, I think they declined, kind of consistent with everything in the last 3 years, at the fastest pace that they have ever declined in 1 month. At least that's what the data has told us. Do you expect that to continue? I know you said 1.5%, kind of roughly right next year.
Yeah, it'll vary obviously by location. And those areas which do better economically won't see as big of a decline. And in some cases, they may not see a decline. It depends on whether they got seriously out of the line to begin with. So the poster child a lot of people look at is Boise, which was over 40% in just 1 year. It's now seen something like 20% of homes have been relisted at lower prices already in this time period. So as I said, our current forecast, and by the way, we forecast quarterly, and we're now publishing that. A lot of people have been after us to publish, so you can see our most recent forecast on the website. And you can even download the history if you want to look at the history of it. Is that the bottom of that cone, that probability cone, would be a 5% decline next year, and then probably another decline the following year.
So, if someone in the audience was fortunate enough to have a seller who said, I would like to sell my home. This is big because we're going to get Doug Duncan, the chief economist, the largest housing finance company in the world, just won a forecasting award. He's going to now talk directly to your seller, right? So you'll have Doug. So what would you tell a seller today if you were their realtor?
I would tell them the expectation is that we're going to have a mild recession in 2023, and that unemployment will rise. The number of buyers that you're likely to face will be somewhat lower than it is today. House prices are at this time falling, and so the prospect is that there will be some additional decline, especially if that recession happens.
So if you get a contract and it's a good contract,
right? I wouldn't panic because every house has a story. right? Every single one has a neighborhood that it's in. It has a price point that it's in. So it's not a story of panic. It's a story about reality and understanding what are the dynamics in that individual market. And that's the thing which realtors are uniquely tasked to do, is to understand the market that they serve. So, but I don't think you're doing your seller any favors if you're not direct with them on what market conditions are, because I've watched some of the folks pre-hurricane in Cape Coral who just had unrealistic views and they didn't act, and it's cost them that they didn't act. So a reasoned approach, I think your point about education and knowing the data and knowing the reality of what's going on in the market is really crucial to serve your customer well.
Well, my slide's not as cool as yours, but it was your slide after all, okay? But we're going to share some information. I'm going to ask you the question, what is you and your team's housing sales, home price increase, interest rate forecast for 2023?
So we believe, let me start with 22, which we think will be down total somewhere in the 12% range or something like that. By the way, you can see our actual forecast up on the website to the extent that you're interested. And then 23, another 15 to, I guess you did put it up, okay. Another 15 to 17% potentially down. We are revisiting, we always go back when we're outside the consensus, which is not unusual. We're often outside the consensus. But we always revisit our analysis to make sure we can explain why we would be different than the consensus. So we have kind of a feeling that, well, are we being too pessimistic about the downturn or not? Part of it's conditioned on where does the Fed go? If the Fed, we are certain that they will go another 150 basis points, 75 at the next meeting, 50 at the following one, and 25 at the next one. If they don't see a turn in core PC inflation, they will go further. And if they do that, mortgage rates are likely to pass the 7% going away.
Yeah. So basically, last month in America, the unit sales would annualize at about 4.5 million. And your forecast next year is more like 4 million.
Yeah.
So to the extent that we're year over year, specifically in the decline, that would be counting the first half of 2022, which was much better, obviously, than the market that we're in today. So the current market we're in, the full year forecast compare for 2023 is really about a 10% decline from what we're all experiencing today. Yeah, we hope you're wrong.
I do too.
We really do.
Fannie Mae likes doing the business too.
Did you have to just win another award for being right? Yeah, so what has to happen for it to go differently? Like, what do we need to see? What should we all be looking for? I know inflation information will come out again in November. The unemployment number and inflation seem to be the two numbers that everyone's kind of pinning themselves on right now.
That's
is that right?
because the Fed is pointing in there. So.
Yeah.
In terms of inflation, there's two measures. There's the consumer price index and the purchase consumption expenditure index. The PCE is the one that the Fed watches. So if you listen to the press conferences, the only measure of inflation that I'm sure Paul has referenced is the core PCE. It rose the last month. If it rises again, it's just a signal the Fed will tighten further, because they've said we're going to tighten it until we see, I don't remember if it was appreciable. I don't think appreciable was the word they used, but significant decline in inflation in place. They're watching the labor market, which is unemployment's currently at about 3.7. You can see the market respond to this when the JOLTS data. JOLTS stands for job opening, and I forget what the LT is, but it's part of the Labor Department report every month. And it lists a number of jobs openings that are listed and the number of people who are looking. And it's been 2 openings for every person that's looking. And last month, the number of open jobs fell by 1.1 million. On the data that released, the stock market rallied, because they're like, nah, the Fed's getting what it wants. And then 2 Fed governors came out and said within the next 2 days and said, that's not actually enough. And so then the market retraced those steps. So the market's very sensitive to that employment issue because the Fed has made them sensitive to it by continually repeating that.
So if there's anyone in the audience that's like me that prays, I don't pray that Alabama wins the football games because I don't want to waste prayers. But I am going to pray that the CPI starts coming down because I feel like that's a righteous prayer, right? People get to pay less for everything, and it'd probably be better for our business. So that's the one number that's out there right now, the inflation number that comes out probably first 2 weeks of November again. And that's a number we really need to start seeing improvement in if we're going to put a cap on rates, which is actually going to help us with our market.
Yeah, and I share the same faith that you do, and I'm always mindful of the fact that Jesus said, the poor you will always have with you, which means to me that we are to be attentive to them at all times, and they're the ones that are most damaged by inflation. So
it's a righteous prayer then, okay? All of you, it's a righteous prayer. We just got the final ruling from Doug Duncan.
It would help to have good policy.
Right. So we're going to take a couple questions in a minute, but I always ask, every time I've talked with Doug, I've always asked you the same question. And again, we'll cut this up for all of you to be able to use with your buyers and sellers. But Doug, is it a good time to buy or sell a home?
Well, I just worked with a well-known mortgage company and bought a condominium. And as is always the case, if you have a household budget and at current interest rates and prices for the house you're interested in, it fits the budget, then you're moving to be a homeowner. If you're waiting to see if prices change in some way or interest rates change in some way, then you're moving into the realm of being a speculator. Some people can afford that. Some people cannot. And so it's always, at least as a reference point, best to have that budget and see how does this fit in the budget. Because if interest rates come down, we were talking about this earlier, with mortgage rates at 7%, it's getting hard to finance them in some cases because anybody in the investor community is going to say, well, as soon as the recession is passed, rates will be down to 5 and that loan will refinance and go away. So that is always the backstop when you're buying into this market, that almost certainly within the next couple of years you will see rates back lower.
Yeah, thanks so much.
My pleasure. Thank you for the invitation.